open a bank account with tax-free benefits related to a disability, you must first qualify for a specific government program and provide verification. The options available depend on your country of residence, but they typically involve special savings accounts or tax deductions. Here are the primary types of programs that allow for tax-free benefits related to a disability. For residents of the United States, ABLE accounts. Achieving a better life experience, ABLE accounts are tax-advantaged savings and investment accounts for eligible individuals with disabilities. What it offers: savings grow tax-free, and withdrawals are tax-free if used for qualified disability expenses. Balances of up to $1 lakh are not counted toward the asset limit for Supplemental Security Income (SSI), and the balance does not affect Medicaid eligibility. Eligibility: to be an ABLE account beneficiary, your disability must have begun before age 26, though this is expanding to before age 46 starting in 2026. You must also either be receiving Social Security benefits, SSI or ACE-DIE, or have a physician certify your disability. How to apply? Most states offer ABLE programs, and you can open an account online. The ABLE National Resource Center has a tool to compare state-specific plans. For residents of Canada, Registered Disability Savings Plan, RDSP. The RDSP is a savings plan designed to provide long-term financial security for people with severe and prolonged disabilities. What it offers: contributions are not tax-deductible, but investments grow tax-sheltered until withdrawn. Withdrawals contain both taxable and non-taxable components, but beneficiaries may be eligible for significant government grants and bonds to match their contributions. Eligibility: to qualify, you must be a Canadian resident, have a valid social insurance number, and be eligible for the Federal Disability Tax Credit (DTC). How to apply? You can open an RDSP through most major financial institutions in Canada, such as TD Bank and RBC. The Canada Revenue Agency (CRA) website has more details. For residents of India, sections ACU and ACDD. While not a specific bank account, the Indian Income Tax Act offers two key provisions for people with disabilities and their families. Section ACU deduction. What it offers: a fixed deduction from your taxable income if you are a resident individual with a certified disability. Eligibility and verification. You must be certified by medical authority as having at least 40% disability. No specific investment is required, just the medical certificate in Form 10IA. Deduction amounts: up to 75,000 rupees for disability and up to 1,25,000 rupees for severe disability. Section ACDD deduction. What it offers: a fixed deduction for a resident individual or Hindu undivided family (HUF) caring for a disabled dependent. Eligibility and verification. The dependent must be certified with at least 40% disability, and you must incur expenses on their medical treatment or an approved insurance policy. Deduction amounts: up to 75,000 rupees for disability and up to 1,25,000 rupees for severe disability. Before proceeding, given the varying tax laws, it is best to consult with a financial advisor or the relevant government authority in your region to understand the most suitable option for your circumstances. When a bank officer or manager references a loan being approved with disability verification and tax-free, they are likely combining two separate concepts related to financial relief for people with disabilities. A loan itself is not tax-free, but certain government benefits or tax deductions for people with disabilities are. The bank's approval is based on your financial eligibility, while the tax benefit is claimed separately when filing your income tax return. Loan approval with disability verification. This means that the bank has provisionally approved your loan, subject to you providing a valid disability certificate. Banks or government-affiliated financial institutions like the National Divyangajan Finance and Development Corporation (NDFDC) offer special concessional loans to individuals with disabilities. To complete this part, you will need to provide a disability certificate issued by a competent medical authority, other standard documents like proof of identity, address, and income. Understanding: tax-free benefits. A loan amount is not an income and is generally not considered tax-free. Instead, The term tax-free likely refers to specific deductions you can claim on your taxable income based on your disability. In India, these benefits are primarily granted under two sections of the Income Tax Act, 1961, Section 80U, Deduction for Individuals with Disabilities. This section allows a fixed deduction from your gross total income if you are a resident individual with a certified disability. Regular disability, at least 40% udas smiley, you can claim a deduction of 75,000 rupees. Severe disability, 80% or more, you can claim a deduction of 1 rupya 25 paise lakh. How to claim? You must submit a disability certificate, Form 10IA, from a government medical authority with your income tax return. You do not need to submit proof of actual expenses. Applicability. This deduction can only be claimed if you opt for the old tax regime. Section 80DD. Deduction for dependent with disability. If the loan is for a dependent relative with a disability, you may be eligible for a similar deduction under this section. The dependent must rely on you for their maintenance. Deduction amount. The limits are the same as Section 80U, ranging from 75,000 rupees to 1 rupya 25 paise lakh, depending on the severity of the dependent's disability. How to claim? You need a disability certificate, Form 10IA, and can claim the fixed deduction regardless of the actual medical expenses. Restriction. You cannot claim a deduction under both Section 80U, for yourself, and Section 80DD, for a dependent, at the same time. Next steps. Gather documentation. Collect your official disability certificate and other necessary financial and personal documents required by the bank. Speak with the bank manager. Clarify the specific documents needed to finalize your loan approval based on your disability. Consult a tax professional. To fully understand how these disability benefits apply to your specific financial situation, it is best to consult with a tax advisor or chartered accountant. They can help you decide which tax regime is more beneficial for you. The user's query is difficult to parse but seems to concern taxes on disability benefits, negative bank account balances, and tax benefits for disabled individuals. Is disability income taxable? The taxability of disability benefits depends on the type of benefit received and the recipient's total income. Social Security Disability Insurance, SSDI. These benefits may be partially taxable if your total income exceeds certain thresholds. For 2025, the threshold is $25,000 for single filers and $32,000 for those married filing jointly. Most people on SSDI do not pay taxes on their benefits because their total income is below these levels. Supplemental Security Income, SSI. SSI is a needs-based program, and the benefits themselves are not taxable. Indian Army Disability Pension. In India, the entire disability pension for armed forces personnel is exempt from income tax. Do disabled people get special tax benefits? Yes. Tax laws often provide special deductions and benefits for disabled individuals and their families. For example, in India, taxpayers can claim deductions under Section 80U and 80DD. Section 80U. For the disabled taxpayer, a resident individual with a certified disability can claim a flat deduction from their taxable income. The amount is 75,000 rupees for person with at least 40% disability, and 1,25,000 rupees for person with a severe disability, 80% or more. Section 80DD. For dependents with disabilities, a resident individual or Hindu undivided family, HUF, can claim deductions for medical expenses or insurance premiums paid for a dependent with a disability. The deduction is 75,000 rupees for disability and 1,25,000 rupees for severe disability. Can banks take money from an account to cover a negative balance? The idea of a bank creating a negative tax and deducting it from a person's account is a misconception. Banks do not have the authority to impose taxes. However, it's possible for a bank account balance to become negative if the account holder overdraws funds or fails to maintain a minimum balance, leading to fees. In these cases, banks must inform the customer if they plan to deduct charges. Bank charges are different from taxes. A bank cannot legally take taxes from a person's personal savings or benefits. If you believe there was a wrongful deduction, you should contact the bank for clarification. Can a disabled person lose their bank account? Having a disability does not prevent a person from opening or maintaining a bank account. However, the terms and conditions of government assistance, such as SSI, may place a limit on the total assets an individual can hold. Asset limits with benefits. For certain programs like SSI, there are limits on the amount of financial assets, including money in a bank account, that a person can have. Exceeding these limits could affect eligibility. ABLE accounts. To help disabled individuals save money without losing benefits, special savings programs like ABLE accounts have been created. Funds in these accounts are not counted against the asset limit for certain federal programs. As a bank officer or manager in India, it's crucial to understand the provisions related to tax benefits for individuals with disabilities, primarily under Section 80U and Section 80DD of the Income Tax Act, 1961. This knowledge helps in assisting customers effectively and ensuring compliance. Here's what you need to know. Section 80U. Tax deduction for disabled individuals. Eligibility. A resident individual in India certified with at least 40% disability by recognized medical authority. Deduction amount. 75,000 rupees for individuals with at least 40% disability but less than 80%. 1,25,000 rupees for individuals with severe disability, 80% or more, which includes conditions like multiple disabilities, autism, and cerebral palsy. Nature of deduction. This is a fixed deduction from taxable income and does not require submission of proof for actual expenses incurred. Documents required. A valid disability certificate, Form 10IA, issued by prescribed medical authority, e.g., neurologist, civil surgeon, or chief medical officer of a government hospital. Tax regime. Applicable only under the old tax regime. NRC eligibility. Not eligible. Section 80DD. Tax deduction for dependent disabled individuals. Eligibility. Resident individuals or Hindu undivided families, HUFs, who incur expenses for the medical treatment, training, or rehabilitation of a disabled dependent. Dependent definition. Spouse, children, parents, brothers, or sisters of the taxpayer, or any member of a HUF. The dependent's disability must be at least 40%. Deduction amount. 75,000 rupees for dependent with 40% to 80% disability. 1,25,000 rupees for dependent with severe disability, 80% or more. Expenses covered. Medical treatment, training, rehabilitation, and premiums for an insurance policy intended for the maintenance of the disabled dependent. Documents required. A valid disability certificate, Form 10IA, issued by a competent medical authority and receipts for expenses incurred. Tax regime. Applicable only under the old tax regime. NRC eligibility. Not eligible. Mutual exclusivity. An individual cannot claim deductions under both Section 80U and Section 80DD simultaneously. Why this knowledge is important for banking professionals. Customer guidance. Bank officers can guide customers with disabilities or those supporting disabled dependents on a way.